Thanks for tuning in to the world of Libertex. In this video, we will explore the latest developments concerning the U.S. Federal Reserve balance sheet and the implications it can have for the markets. Last week, the Federal Reserve holdings for assets, bonds, and other liabilities decreased for the fourth consecutive week, seeing a decline in its balance sheet by approximately $88 billion, going from $7.06 trillion to $6.97 trillion as of July 8th. While the difference between the overall numbers may seem small, it is actually the largest decrease to the balance sheet in over 11 years. Dylan Janis, analyst at Libertex, weighs in with his take on the situation and what it could mean for the markets and recovery.
Hi everyone, this is Dylan at Libertex, and today I just want to quickly review the developments over the course of the last 4 weeks regarding the decreasing Federal Reserve balance sheets. Now, the data has been quite astounding when looking at the week-over-week balance sheet results. What can be seen now is a pattern of contraction, which could lead to significant reverberations across the markets. If we go back to February, during the height of the pandemic, the Fed's balance sheet totaled $4.17 trillion, climbed up to $5.25 trillion by the end of March, and peaked at $7.17 trillion on June 8th. Now it seems like that pattern is reversing, which could come as a result of a decline in the demand for dollar swap lines, as well as repurchasing agreements. The repurchasing agreements are very interesting because just last week they were $61.2 billion, and now they're at an almost unbelievable zero. The Fed has promised to do whatever it takes to help drive a recovery across the markets, and it seems to be working. In addition to renewed confidence in areas of the stock market, gold has been making record advances that correspond to the Fed's monetary policies. However, if stimulus actions fall short and, for example, the S&P 500 stalls, the rally for gold may be short-lived. This is definitely something to keep an eye out for when assessing the Fed's balance sheet data in the near future.
Eduardo Rico, senior analyst at Libertex, states in regards to the update.
Yes, indeed, they made 4 consecutive declining in the last weeks. Partially can be explained by the lift of announcement in September 2017, when the unwinding of the balance sheet was underway with a taper of $50 billion per month. They had expected to reach a balance sheet below $3 trillion this year. By simply letting the balance sheet slowly decline by not reinvesting, but due to the market fragility seen last year, the Fed decided to intervene in the repo market in September after a shortfall of bank reserves led to a record surge in short-term borrowing costs. It ramped up that support to unprecedented levels in March after concerns over the rapidly spreading coronavirus disrupted financial markets. But don't be naive. The Fed not only have a long experience since the crisis of 2008, as they know that it's essential to build confidence and stability in financial markets. The recent data from US can suggest that the crisis is not so scary or just at the beginning. With the stabilization of the unemployment rate around 12% for the moment, but we are at the very beginning of this health crisis, and more to come is the most probable. With the increase of new infections in the US over the last week.
How do you feel about the actions of the U.S. Federal Reserve? Do you view this as evidence of a coming economic recovery? Let us know in the comments. For more information on trading and the latest news from the markets, make sure to like and subscribe to our channel to stay up to speed. Thanks for watching, and see you next time.